A few hours ago, the stock market fell more than 800 points, and at the very same moment, gold went up, not down, up on the exact same news. In the exact same hour, two of the most watched assets in the world moved in completely opposite directions, and almost nobody is stopping to ask why. I am here to tell you that this divergence, stocks crashing while gold climbs, is one of the most important signals this market can give you. And it just flashed bright and clear in front of an audience that mostly missed it because they were staring at the falling stock numbers in fear. By the end of this video, you are going to understand exactly what it means when these two move apart like this, why it happened today, and what it may be telling you about the months ahead. Stay with me because this single divergence explains more about the real state of the financial system than any headline you will read tonight.
And here is the twist, the part one want to hand you right now instead of making you wait because it reframes everything. When stocks and gold fall together, it usually means a simple scramble for cash. Everyone selling everything at once. But when stocks fall and gold rises at the same time, it means something far more specific and far more revealing. It means money is not just fleeing risk. It is fleeing toward safety, toward the one asset that has protected wealth for 5,000 years, precisely because something the Federal Reserve said today frightened the people who own stocks and reassured the people who own gold. Those are two different messages carried in the same announcement, and the fact that gold heard the reassuring one while stocks heard the frightening one tells you exactly where the smart, cautious money believes this is all heading. That is not noise. That is a signal, and I'm going to show you how to read it.
But before I go further, I want to know who is in the room with me right now. Tell me in the comments where in the world you are watching from, and tell me honestly what you are holding. Gold, silver, stocks, cash. Waiting on the sidelines? Tell me, because I read these. And on a day when stocks and gold split apart like this, the mix of your answers tells its own story about who is nervous and who is calm. And I promise you, I will come back to what those answers mean before we are done. Let us start with what actually happened today, plainly, because the details matter. The Federal Reserve held interest rates steady, which was expected, but the committee was openly divided, with members disagreeing about whether to hold or to raise, and a handful of them dissenting from the decision, wanting to push rates higher right now. That open disagreement matters more than most people realize, because when the guardians of the dollar cannot even agree among themselves on the path forward, it broadcasts a rare kind of uncertainty from the very top of the system. And uncertainty at the top is precisely what gold is built to answer. And then the chairman stepped up to the microphone and delivered a message that was anything but soft. He declared in plain language that this Fed will not waver. He said that 5 years of inflation running too high cannot be cured in 9 weeks or by a single month of better numbers. He reaffirmed forcefully that the Fed's credibility rests on delivering price stability, and that they would deliver it. This was a chairman planting a flag, telling the world he intends to stay tough on inflation no matter what. And the stock market did not like it one bit. The Dow fell more than 800 points, but gold quietly went the other way and rose. Hold that contradiction in your mind, because unpacking it is the whole point of this video. To understand why, you have to understand the machine at the center of it, the single lever that moves everything. The Federal Reserve's most powerful tool is the interest rate, the price of money itself. When they raise it or signal, they will keep it high. Borrowing gets more expensive. The economy slows. And this is generally bad for stocks because companies borrow to grow, and slower growth means smaller profits. That is why a tough-talking, inflation-fighting chairman sent stocks tumbling today. The market heard higher rates for longer, and it heard a headwind for corporate profits, and it sold. But gold plays by a different rule book, and this is where it gets interesting. Gold and silver pay you nothing. They earn no interest, no dividend. They simply sit there. So the textbook says that when rates stay high, gold should suffer, because holding it means giving up the interest you could earn elsewhere. Economists call that opportunity cost. And by that simple logic, gold should have fallen today alongside stocks. But it did not. It rose. So the textbook by itself cannot explain what you just witnessed. And the reason it cannot is the single most important thing I can teach you today. If you are finding this useful already, take a moment to like this video and subscribe. Because now I am going to explain the one thing that makes today's divergence make perfect sense. And it is the thing that separates people who understand this market from people who only read the headlines. Here is the key. Gold is not only a bet on interest rates, gold is a bet on trust. It is a gauge of confidence in the entire system of paper money and the people who manage it. And today, the chairman's defiant, "We will not waver" message did two things at once. To the stock market, it signaled painful rates ahead, so stocks fell, but to the gold market, it signaled something deeper and more troubling. It signaled a Federal Reserve that is genuinely worried, digging in for a long and difficult fight against an inflation it openly admits has run too high for 5 straight years. When the most powerful financial institution on earth stands up and essentially says, "This is hard. This will take a long time, and we are worried enough to plant a flag about our own credibility," the people who own gold hear a confession. They hear that the guardians of the dollar are struggling, and they buy the one asset that does not depend on those guardians succeeding. That is why gold rose while stocks fell. Stocks feared the rates. Gold sensed the deeper struggle underneath the tough talk. Let me make this real with two people, because these forces only matter when you see how they land in an actual life. Neither is real, but both are the kind of person you might recognize, perhaps in the mirror. The first I will call Walter, 69, retired. And Walter spent this afternoon watching the stock ticker in rising panic as the Dow shed 800 points. All he saw was red. All he felt was fear. And because his eyes were locked on the falling stock numbers, he never noticed that gold, at that very moment, was quietly climbing, telling a completely different story. Walter saw only half the picture, the frightening half. And he will likely spend tonight worried about his stock portfolio, while missing entirely what the divergence was trying to tell him. He watched the fear and missed the signal. The second person I will call Frances, 66. And she is not richer than Walter and not smarter about economics. She simply watches both sides of the seesaw. When she saw stocks falling and gold rising on the same news, she did not panic. She understood immediately that this split was the real story, that money was moving from risk towards safety, and that the reason her gold existed in the first place, as protection for exactly these moments, was proving itself in real time. But here is the deeper thing about Frances. She did not rush to trade on it, did not scramble to buy or sell, because the reason she owns gold does not rest on any single afternoon. She read the divergence to understand the weather, not because it changed the reason she built her shelter. The difference between Walter and Frances is not knowledge. It is that one of them watched only the falling thing in fear, and the other read the whole seesaw and understood what it meant. Now, why is it so hard to be Frances and so easy to be Walter? The answer is not weakness. It is biology, and understanding it is one of the most useful things I can give you today. When you watch something you own fall in value, the part of your brain that processes physical threat, The same ancient machinery that once helped your ancestors flee a predator fires off before the rational thinking part of your brain can catch up. A plunging stock ticker does not register in your body as a data point. It registers as danger, and your body floods with the chemistry of panic, which locks your attention onto the threat, the falling number, and screams a single instruction: do something. Protect yourself. Now, this is exactly why Walter's eyes stayed glued to the crashing Dow and never wandered to the rising gold price beside it. Fear narrows your vision to the threat and blinds you to everything else, including the signal that would actually help you. The investors who thrive are not the ones without fear. They are the ones who have trained themselves in the moment of panic to widen their gaze, to look at the whole board instead of only the burning corner of it. Today, the whole board was telling a richer story than the falling Dow alone. And if you own silver, today handed you an even sharper version of the same signal, because silver did not just rise with gold. It rose harder, outpacing gold on the day. This is silver's nature, and it is worth understanding. When money moves towards safety, silver tends to move 2 to 3 times as much as gold in percentage terms, because it is the more volatile, more energetic cousin. But silver has a second engine gold lacks, because more than half of all silver demand is industrial, physically consumed by solar panels, electronics, electric vehicles, and the data centers powering the artificial intelligence. Boom. So on a day like today, silver was lifted by 2 forces at once. The same flight to safety that lifted gold, plus its own relentless industrial demand. That is why it outran gold. And it is why silver, for the saver who can stomach its wilder swings, so often amplifies exactly the move you saw in gold today. It is not simply a cheaper gold. It is its own animal with a second engine underneath it. And on days when the whole board tilts towards safety, silver tends to tilt hardest of all. Now, let me be honest and careful with you, because I will not insult you with fear, and this subject draws people who want to frighten you into acting. A single day of stocks falling and gold rising is a meaningful signal. But it is one day, and one day does not make a trend. It is entirely possible that tomorrow the picture shifts, that stocks recover, and gold gives back its gain. Because markets are noisy, and no single session is destiny. Gold has had a genuinely difficult year, down from its January record, and it is not immune to falling again. Anyone who tells you today's divergence guarantees gold is about to soar is guessing and dressing the guess as knowledge. And they deserve your suspicion. What I am giving you is not a prediction. It is a way to read what happened, so that whatever comes next, you understand the language the market is speaking instead of merely reacting to the loudest number on the screen. Let me give you something practical. Then, a way to use this going forward. From now on, when a big piece of news hits, do not just watch one asset. Watch the relationship between them. When stocks and gold fall together, the market is simply scrambling for cash, and it usually passes. But when stocks fall and gold rises, as they did today, pay close attention, because that specific divergence is the market telling you that fear is turning structural, that money is seeking not just to avoid risk, but to preserve itself in something real. And watch what comes next in this particular fight, because the chairman drew a line today. Markets are now pricing a strong chance, around 80%, that the Fed raises rates at its September meeting. If that hawkish resolve holds, expect more days like this one, more pressure on stocks, and more nervous money eyeing gold. Now that you know to watch the relationship and not just the number, you are reading this market at a level most people never reach. And here is the piece that puts all of this short-term drama in its proper place. The piece I most want you to carry away. While ordinary investors panic over each Fed meeting and each market swing, the largest and most sophisticated buyers on the planet, the central banks of entire nations, have been doing the exact opposite. They have been buying gold steadily, quarter after quarter, at a pace not seen in generations. They bought a net 244 tons in the first quarter of this year alone. And a recent survey found that the highest share in the survey's history expect to keep increasing their gold reserves in the year ahead. Think about what that means. The most informed money in the world is calmly accumulating, the very metal that ordinary investors panic over, buying steadily through every frightening headline. They are not watching today's 800 point. Drop the way Walter is. They are buying for reasons that operate across decades. And today's divergence, stocks down, gold up, is a small daily echo of the very logic driving their enormous patient accumulation. When you feel the urge to panic over a day like today, remember who is quietly on the other side, calmly buying what the frightened are selling, and ask yourself what they understand that the panicking crowd does not. There's a deeper force under all of this too, one that shapes how it must eventually resolve, and it is worth understanding. The United States government now carries a national debt of more than $39 trillion. And the interest bill on that debt alone has climbed past $1 trillion a year. Every time the Fed raises rates or holds them high to fight inflation, it makes that debt more expensive to service, blowing a bigger hole in the government's own budget. This is the trap beneath today's tough talk. The chairman may declare that the Fed will not waver, but the arithmetic of the debt puts a ceiling on how long anyone can keep rates high on a mountain this size. This is why so many sophisticated investors believe that whatever any single chairman says on any single afternoon, the long-term direction must eventually bend toward looser money, toward tolerating more inflation, toward a slowly weakening dollar, because the alternative is simply unsustainable. And a slowly weakening dollar over the long run is precisely the environment in which gold has historically preserved its value, while paper money bled its away. Today's divergence is a single scene in that vast, slow story. And understanding the story is what lets you keep your nerve through any single scene of it. There is history here, too, worth knowing, because it shows how this plays out over time. Go back to the 1970s, a decade of raging inflation and a Federal Reserve that talked tough while struggling to actually contain it. Through that period, stocks stagnated and often fell in real terms, while gold, over the full decade, climbed from around $35 an ounce to over $800, an extraordinary rise. There were many days in that decade when stocks fell and gold rose on the same news, each one a small signal of the larger truth that confidence in paper money and its managers was draining away, even as the officials insisted everything was under control. The lesson is not that history repeats exactly, because it never does. The lesson is that the divergence you saw today, stocks down and gold up on a hawkish Fed, is a pattern with deep historical roots. And it has often marked the moments when the smart, cautious money was quietly moving toward safety while the crowd stared at the falling stock ticker in fear. So let us pull it all together and go back to that strange split you witnessed a few hours ago. Today, the Federal Reserve held rates, but stood divided, and the chairman delivered a defiant "We will not waver" message about fighting inflation. The stock market fell more than 800 points, hearing painful rates ahead. But gold rose, hearing something deeper, a Fed openly struggling against an inflation it admits has run too high for 5 years, a confession of difficulty that sends cautious money toward the one asset that does not depend on the Fed succeeding. That divergence, stocks down and gold up on the same news, is the real signal of the day, far more revealing than the falling Dow alone. And it is the kind of signal that rewards the patient and punishes the panicked. The next battle is set for September, where markets see a strong chance of a hike. And through all of it, the central banks of the world keep buying gold, calmly, for reasons that a single afternoon cannot touch. So here is what I want you to carry away, framed as plainly as I know how. Today's split will echo into the coming days, and neither I nor anyone else can tell you exactly how.
But the divergence itself taught you something that no single price ever could. That in moments of real stress, stocks and gold can move in opposite directions, and that when they do, the direction gold moves is a window into hold gold and silver as protection against a world of staggering debt and uncertain money, then a day like today, stocks falling while gold rises, does not weaken that reason. It quietly confirms it. Because the whole reason gold has endured across every empire and every currency that has ever risen and fallen is that it holds its worth in exactly the moments when confidence in everything else